Transferring commercial property into your SMSF can trigger significant stamp duty, and the amount varies dramatically by state. In this video, we break down what you'll actually pay across Australia and reveal strategies that could save you thousands. Let's dive in.
Everyone, and welcome. Today, we are diving into a really powerful wealth strategy, how to move your commercial property into your self-managed super fund. Now, this can be an absolutely brilliant move for your retirement, but there's a single hidden cost that can stop you dead in your tracks. So if this strategy is on your radar, you are in exactly the right place. I mean, it's a fantastic way to build your nest egg using an asset that you already know and control. But before you get too excited, there's one major hurdle you absolutely have to know about. You heard that right. A single tax paid up front that could cost you over $40,000. This one thing can make or break the whole plan. It's a huge number, and honestly, it catches a lot of very smart people completely by surprise. So let's break down what it is and, more importantly, how you can avoid it. Okay, let's get into it. The big hurdle we're talking about here is stamp duty. It's the one critical factor that can turn a brilliant financial move into a really expensive headache if you don't plan for it the right way. So, what even is it? Well, to put it simply, stamp duty, sometimes called transfer duty, is just a tax your state government charges whenever a property changes hands. And here's the real kicker. Even though you're just moving the property from your name to your super fund's name, the government looks at it and says, that's a sale, and they tax you on the full amount.
Let's put a real number on this so you can see what I mean. For a pretty standard $1 million commercial property, say in New South Wales, you'd be looking at a stamp duty bill of around $40,490. That is a massive upfront cost that takes a huge bite out of your investment.
And to make things even more fun, it's not a one-size-fits-all problem. Oh no, every single state has its own set of rules, its own tax rates, and its own weird sliding scales. This table just gives you a little glimpse of the problem. It is a total minefield out there, and it changes depending on where you live. But here's the good news. That hurdle, it's not impossible to get over. In fact, buried deep inside all that complicated government legislation, there are specific exemptions and concessions that can slash this cost, or sometimes even get rid of it entirely. You just have to know the playbook.
And wow, does this show you the power of knowing that playbook? Let's go back to our $1 million property in New South Wales. Instead of forking out over $40,000, if you qualify for the specific SMSF concession, that duty gets crushed down to a tiny fixed fee of just $750. That's a saving of nearly $40,000. Incredible, right?
So how do you get this amazing deal in New South Wales? Well, the rules are very specific, but they're doable. First, the property has to be what's called business real property. Think your office, your workshop, your factory, a property used exclusively for business. Second, the members of the super fund have to be the exact same people who own the property personally. No changes. And finally, the whole thing needs to be documented perfectly as a contribution into your super. Okay, so what if you're not in New South Wales? Well, Victoria also has some pretty helpful concessions for what they call in-specie contributions. For most of the other states, though, there isn't a simple, direct SMSF exemption like that. The key strategy there often gets a bit more complex. It's something called corporate reconstruction relief, and it might apply if your property is already held inside a company structure. So, a bit more complicated for sure, but the path to savings can still be there.
All right, let's zoom out for a second. Because saving a ton on stamp duty is fantastic, but it's really just the first step. The real reason this whole strategy is so powerful is because of the long-term benefits. But, and this is a big but, those benefits are tied directly to following a very strict set of rules. And believe me, these benefits are what make it all worth it. Once that property is inside your super fund, any rent it earns is taxed at a flat, concessional rate of just 15%. Then, when you eventually sell it, the capital gains tax can be as low as 10%. And the best part, once you retire and switch your fund into pension phase, all the income and any capital gains can become completely 100% tax-free.
But, and you knew there was a but coming, those amazing tax breaks don't just get handed to you. They are protected by some very strict compliance walls. If you mess up, if you fail to meet all the requirements, you don't just miss out on the benefits, you could find yourself getting a bill for that full $40,000 stamp duty payment later on. So you absolutely have to understand these non-negotiable rules. The transfer must be done at market value, and you need an independent valuation to prove it. We've said it before, but it must be genuine business real property. Remember, the value of the transfer will count towards your super contribution caps for the year, and it could trigger a capital gains tax event for you as the original owner. But above all, the whole strategy has to pass the sole purpose test. That means its only goal can be to provide for your retirement, not to get some kind of sneaky business advantage today.
So you know the incredible rewards, and you know the serious risks. How do you actually pull this off and create a winning strategy? Well, it really just comes down to following a clear, disciplined process.
Here it is, your 4-step game plan for success. Step 1. Plan early. Figure out what your stamp duty and capital gains tax situation looks like before you do a single thing. Step 2. Look at the whole picture. Don't just get fixated on the upfront cost, think about the long-term returns and all the compliance. Step 3. Work with pros. Seriously, this is not a DIY project. You need SMSF specialists on your team. And Step 4. Document everything. Meticulous records are your absolute best friend and your proof that you've done everything by the book.
At the end of the day, transferring your commercial property to your SMSF can be one of the smartest, most effective moves you ever make for your retirement. Yes, the hurdles are significant, but as we've just seen, they are completely manageable with the right knowledge and planning. So the only question left to ask is, are you ready to take that next step?